You called it the red letter day in your piece. I think this was because of overlending, which is an internal reason.
Because Reserve Bank of India gave them freedom, which they were asking for. But I think even Reserve Bank of India regrets that because the freedom is, I'm sure industry will hate me for this, it's been misused. One borrower I came across having 14 exposure, 1/4.
So, sir, help me understand the number going so high, like almost 4x between 2020 to 23, 24, and then also falling. All of this, I guess, was a function of supply elasticity, right? Because I'm assuming the demand for such loans was always there.
So people are taking more money than probably they require also. It was a supply side problem. It was not a demand side problem.
Hi guys, I'm your host Kashish Kapoor and welcome to another episode of Subtext. In today's episode, I have with me a special guest, Tamal Bandyopadhyay ji. He is one of the most coveted Indian banking journalists and he's covered banking for past 2-3 decades. When I first talked to him, he refrained from calling himself an expert. He called himself more of an observer of banking ecosystem. And he's not just an outside observer, he was earlier associated with Bandhan Bank as well, and now is currently a senior advisor at Jana Small Finance Bank. In the end, he's an expert at everything banking. And today, I'm talking to him about microfinance industry. Now, for those of you who don't know, we also did a video on microfinance industry where I went through 144 con calls across 18 companies and 8 quarters to see how the microfinance industry went through a credit cycle. So if you want to watch that video, go check that out. This conversation was recorded after that research, and I was very excited to discuss everything I learned with Tamalji. Not making you wait any further, here's my conversation with him. Thank you so much, Tamal sir, for agreeing to do this. By the way, this is a personal fan movement for me. I started learning about banking reading from the Pandemonium book. Somebody suggested, and ever since then, just like you talked about in our call earlier, I've also become an observer of banking. Although you've been doing it for decades, it's just been a couple of years for me. But I'm just enjoying this process of observing banking cycles. So thank you so much for introducing this to me, first of all.
Thank you. Thank you.
So, sir, I want to talk about microfinance. There are a lot of questions I have, but I want to first start with a very basic thing. What does microfinance mean? The reason I ask this is because RBI says that it's unsecured sort of loan given with a particular ticket size. But what confuses me is almost everything can be categorized as microfinance. So, a joint liability group loan given could be a microfinance loan. A loan given by a fintech app can also be categorized as a microfinance loan. A business loan given to Kirana shop, which is also unsecured, can also be microfinance loan. So, is there a clear, defined way of us to know what exactly is microfinance loans? And when different businesses, let's say a Kotak defining what their MFI books look like, and if a small finance bank like AU defining what their microfinance book looks like, are they comparable? So, first, I just want to understand that.
Yeah, I think it's very interesting question. In fact, that was the case till I would say April 2022 when Reserve Bank of India came out with the new norms. Now, till that time, you know, it was not exactly defined what is microfinance, which is why there was a lot of overlapping between microfinance entities and the banks. They are doing the same thing, and and a lot of problems were created for that, over leveraging and everything else, because there's no TARF as such, one getting into another. So there are microfinance entities, right? Even now they are. But what is microfinance was not defined. So everyone was jumping into it and creating problem, lot of problem. In fact, Assam problem, I'm sure you talk about it later, just during the COVID time and around or before that happened. That was because of that. One large lender took advantage of this, and what it was doing is what is actually micro lending and all. Let's a separate story. But 2020 thing, actually, Reserve Bank of India started looking at microfinance, not microfinance entities, microfinance as a subject, as a segment. So if you're a bank, the rules are same for you. If you are a non-bank, the rules are same for you. It could be an NBFC and MFI, NBFC and all, but microfinance norm, same for you. What is this microfinance norm? RBI for the first time came up with this, which talks about what will be the household income and That's one part of it. Second part of it, of course, one very critical part which is evolving is earlier what it was happened, a microfinance, if you are a microfinance entity or you are into microfinance, you can give up to 15% secured loan. Later, it became 25%. And now it's 40%. This is to save the microfinance entity. Look, you guys got into trouble. Now I am allowing you to have more and more secured loan to balance it out. So from 15 to 25 to 40, that has gone for the microfinance entities. But what microfinance is very simple, that household income, if I'm not mistaken, is capped at 3 lakh. Beyond that, you cannot give other. The ability to pay back, I think, has to be the 50% of the household income or something like that on that level. And earlier it was there, largely it has to be productive loan, but Reserve Bank of India 2022 said that no, it can be for education, it can be for a few other things as well, not only the productive purposes of. So now, whether you are a bank or non-bank, the NBFC or MFI NBFC, if you are getting into that segment where the household income is capped at there and you are giving loan and following these norms, this loan is treated as microfinance. Of course, and the challenge is how do you, even though despite the GST etc. coming in, how do you define household income? Actually 3 lakh, how do you go by this? So these are all very gray areas are there. And one of the reasons or the key reason for the problem is this. I mean, people don't care much about, yeah, there is 3 lakh, but well, you know what I mean.
So now that we've defined, microfinance as a category of lending, one thing that I've observed is that this is a category of lending which is very prone to a lot of credit cycles. And these credit cycles are more industry wide than just company specific. We've obviously seen the Yes Bank thing happened. Then in 2018 also we had lending. All of that has happened, but the intensity with which crises like the 2010 Andhra Pradesh crisis happened and then 2021 Assam crisis happened, these happened across industry altogether. And they happen much more frequently as well. Which begs the question, is this a feature of microfinance itself that it's so prone to such cyclicality? Or am I missing something here?
There are actually multiple factors that can affect. Remember, this is the class which is not the privileged class which have the access to bank loan, which can afford for secure lending, etc., right? So they are actually, the microfinance is replacing or substituting money lenders, right? And that's how they justify their higher loan, that even though we are charging 24%, 26%, 28% odd, but still we are much less than money lender. But they're a very vulnerable section. Now, this vulnerability leads to multiple things. One is this, very often you will find that, say, natural calamities. This could be earthquake, this could be cyclone, it could be flood that can affect them. It's a very regional specific thing. As Sam, you said, it's a different thing altogether. It's actually in some segment on Assam, in tea gardens, etc. Uh, the borrowers were hugely over leveraged, reportedly by one bank. That particular bank actually thought that, oh, this is my area. I am creating this. I'm making awareness of people about microfinance and I'm giving them money. Suddenly, why the other entities are also flocking in on so that particular entity started giving more loans, then and the borrowers can pay back. Now, what happens is, if I'm a borrower and if I'm taking 2 or 3 loans or 4 loans, which I should not, but still I can arbitrage, like taking money from one and giving money to another. But then suppose I was getting 3 lakh, 30, I was paying some, so getting say 30,000, 30,000, 30,000, and 90,000 from 3 persons. I could have arbitraged and managed, a balancing act. But if one person gives me 90,000, I need to pay back. And then I've not been able to pay back. So it was over leveraging, and it was probably an adventure by one particular large lender, which is not a microfinance entity. That's the play to Assam crisis. Similarly, the many years back, the Andhra Pradesh crisis also created by one particular entity, which got merged to a large private bank later, which was actually got listed and got into trouble and all. I'm not naming it. So what happened is this: the collection thing getting messy, and it led to suicides of people, so on and so forth. That's why the Andhra Pradesh government came in. This 2010. What happens is, one is the natural issues, natural calamity, etc. It can affect. Then the political thing also it can affect. Like s- many of the state norms, it says that they're not applicable to RBI and RBI regulated entities. Recently, yet another southern state gone for it. It categorically says these norms are not meant for RBI regulated entities, which means technically it is not applicable to RBI regulated entities. But what happens in reality when you have that, then people, even though the borrowers which are given money by RBI regulated entities, they get influenced and they don't want to pay like that. Similarly, it often it happened in the first decade when the central government issue lot of money, there's a loan waiver they it announced in the budget. Yeah, it's central government, but if you see periodically multiple state governments ahead of the elections, and they talk about this waiving the loans and paying back the loans, etc., etc. So that creates uh, issue which is essentially that damages, that hurts the credit culture. So what happens is, even if I'm able to pay, I'll say I'll not pay because the state government is there to help me out. But my fellow guys, they're genuinely inconvenienced for whatever reason. I can pay. But those who are able to pay also, they get influenced by that. And some cases like the recent one which we had seen in the past, which is now things are getting better. I'm sure you're planning to discuss it later. I'm not getting to that. That reason is slightly different than others, but historically every few years you will see the problem, and the genesis of the problem, the trigger for the problem, it can be political issues, it can be collection, aggressive collections which created the political issue, it can be before elections, loan waiver. It can be cultural issues, meaning the culture of particular entities which allows people to over leverage, or it can be natural calamities. So there are multiple things which is the banking system or the secured lending in NBFCs, they are not subject to. So which is why I think the investors in this such entities, they know for sure that look, every 4 or 5 years, I'll not get any money for 2 years or 3 years. So when I'm getting money, let's make they will put pressure on the particular entity that look, well, it has to be. That's why they will not compromise on their return. So so you make good returns for a few years, and then you don't make any money. You make loss for a few years, and then that's the balancing act you need to do.
I think I read somewhere where it was mentioned if you want to understand credit cycles, MFI is the best industry because that's where you see live examples happen very frequently, and you can actually see how the NPAs are moving. All of that happens in a very real time, in a very quick basis. So you can learn very fast. And I eventually did see that happen for the past couple of years. But adding on to what you mentioned, the regional aspect of it, right? So is there a way for that to not impact an MFI business? I understand that these are politically sensitive issues and it's hard for us to distinguish between them. But do we see a future where, I don't know, it's a very hard question to answer, but do we see a future where such regional politics, such local things do not impact MFI industry? Or it's just the nature of MFI industry and investors just have to deal with it?
No, I think you can't avoid that. You can't avoid that because, again, if you look at the numbers, now the different states have different, the MFI size, etc. is very different. Concentration is very different. As I speak, just I'll tell you that the 5 states that lead the microfinance thing and all, I'm just reading out from something which is believable. I'm not talking about the source, but they're following the latest. Now for Bihar, the number of borrowers has fallen from 11.34 million to 9.15 million in the recent the crisis. Uttar Pradesh from 8.99 close to 9 million to 8.012 million. West Bengal from 6.9 million to 6.15 million. And Karnataka from 6.28 million to 5.46 million. So all these five states in recent whatever the turmoil what you're seeing, that's only Tamil Nadu was relatively less impacted. Here the number decreased from 8.11 million to 7.92 million. So, as you have said, there are no different states are different things. As you say that Tamil Nadu is different from the other few places. So it depends on the leveraging. It depends on the lenders, It all depends on the lenders, how the lenders behave. And problem is this, even though despite all the credit bureau, etc., in that segment, it's not, say, 5 years back, it was microfinance and money lenders. But now it is no more microfinance and money lender. Now there are multiple lenders are there. All the fintechs, they're there, and they're not necessarily their exposure is caught by the credit bureaus and all. So, as a microfinance entity, you might have seen that one particular person has taken three loans, because you get to know from the credit bureaus that he or she has two other exposure, and you are giving it because your SRO says up to three loan, not more than that. But that person, the lady, the woman or the man, probably has two or three more loans from non-microfinance, non-NBFC, non-banks, but fintechs. And they are equally expensive, 40%, 50%. I know that kind of things happens and all. So it's very, very, I'm just saying the field, the turf. No, one way of looking at is this GST has come and things are now getting better. You can measure people's income, so on and so forth. But on the lending side, in the unsecured space and small loans, there are issues which is very difficult. It's complicated. Credit bureaus are there, and the microfinance entities, like everybody else, need to check the credit bureau. And so, but the credit bureaus have not been able to catch everything because of the fintechs, which is why Reserve Bank of India also concerned. They are talking about white labeling fintech, so on and so forth.
If I understand correctly, sir, all these fintechs have been giving loans not with any lending license they've gotten from RBI. They've just been doing it out of their books, for lack of a better word, illegally. Is that the right way to put it?
Not exactly like that, but they're not caught. I give you one live example. I was in Kolkata and in a bar. Well, well, I used to like when my college or university days I used to go there. Then I found that in particular bar, one particular table, there are 5 or 6 guys were there, and they're little making more noise than others. People are not very happy what they're doing, but they would not dare to tell them because they're in their 20s, young kids. So I took the chance, let me see, and I tried to just chat with them and all. And trust you me, I found out that they all had taken money loan from fintech to finance their beer drinking. And two of them have come up very, very pretty good background. One lawyer's son and one some pretty responsible businessman's son. Other three, 5 or 6 of them. Some of them giving tuitions, etc., etc. And I'm told that they are of course paying back, and they are given 44% interest. 44% interest they are paying, and the what is the hook for them? Why have they taken it? They have not defaulted. They said, look, one is this, no bank will give me money. I'm getting money there and all. And second is, they have been told that, look, this is the way I will get you into the credit cycle. Credit bureau will catch you, and later you will be credit worthy, etc., etc. And that 44% in due course for a few cycle after that, it will come down to much less, 36% or all. And then I definitely name the entity. Then I look around for that entity and found out that they have pretty good book, and these are all, they have not raised money from anybody, from their own capital they are using. And some segment is there. I was talking to one of the guys who are the auditor there. They said, no, they're doing good business. And yes, in some cases, this 44% or 40%. And then for employed person, they are charging much less. Salaried person, they are charging much less, 18%, 16% kind of thing.
And these are not, say, RBI registered entities.
I would not think so. I would think no. I think I mean I on this I just don't have the answer actually. If you tell me, I don't think anything illegal they are doing. I don't think so.
Got it. And so help me understand, sir, if credit bureaus are not able to capture this data.
Not because are capturing RBI. In fact, have you seen that RBI recently, quite some time back, they said the rapidity, the velocity of giving the data they have increased, etc., etc. The time lag was much less and all. But what I am just saying precisely, despite that, yes, the it has become much faster, but not every data, because certain entities in that space, unsecured small lendings, and particularly the fintechs and the loan apps, they are every entity is not caught by. Now, whether it is illegal or they are not licensed by RBI, I am not qualified to say. But we understand that RBI is concerned and RBI is tightening the now on the digital lending space. It's talking about a white labeling part, like you need to be approved by RBI and all. I think that process is on. You will see it soon. But as we speak, and or it had been the case.
Fair enough. So in that case, sir, if credit bureaus again they don't have full access to all of this credit data, how does underwriting happen in MFI space? I know that joint liability group method is another one where they take joint liability of the group, but from what little I read over past couple of years, even that is breaking. That whole model is breaking. Even I don't want to get wrong, but I guess I read it in Kotak's con call where they mentioned that they want to go for more data based underwriting, even in microfinance unsecured, than going with the JLG model. So, first, why don't you help me understand a bit how JLG model works? And then, if JLG model is not working, we do not have enough credit data. How will underwriting happen in microfinance?
That's the problem. But first of all, yes, you are absolutely right. The GLG model is it's not no more the say till recently. I guess a few years back, GLG model was there. GLG model was the overwhelming model even for microfinance entity apart from the banks and all. But now the GLG model will not work. The main reason is you know Reserve Bank of India, again, I come back to 2022 April, the new norm. Apart from what is microfinance and no more microfinance entity, but identifying microfinance, RBI also give them the license to fix the market rate interest rates. Earlier, it was there. Depending on your size, your average cost of borrowing plus 10% for, I think, larger for 1,000 crore plus microfinance, and below it was 12% or something like that. And there are, of course, calculation how to do this and all. But Reserve Bank of India had the no. But 2020 April, after this, I mean, during the COVID time, Reserve Bank of India freed the things. Now, what happens is that gives the entities freedom to lend at whatever the thing depending on the cost of funds. And RBI thought it would be market driven, it would go down. It's another matter. I would say probably each and everybody has reason. Why did they do it? Because during the COVID time, FY1 and FY2, their business was bad and the NPAs were going and a book was not growing. So they want to make over that whatever the losses they did and all. That's a separate story. But that was a big hit on the JLG model because what happens is this on the JLG model, when I have a group, say I have a group of 16 or 20 or whatever it is, I am giving you loan at the same rate, everybody. Now, when I am able to, when I have the freedom to decide on the loan, now I will not say that all 16 will get the same at the same rate. No, there'll be five guys can get cheaper, another 10 guys can get higher, much higher, one guy can get mid level and all. Now, how do you create a group where you are lending money at different rates to different persons? Certainly, it will not work. And of course, the other part was the GLG model. As we go to more into the digital space and all, the entire thing of the traditional way of doing it, that going there, holding group meetings every week or every fortnight, and fixing a leader who will actually collect on others' behalf and all. Now that's history because of digitization, you know. And there was what was happening is this was, the opex was, the cost was too high, and digitization has actually bring them to bring down the opex cost. But as a necessary corollary to that, all those connectivity etc are being affected. So what happened is this: it has to be the right way of doing is this. It has to be either, I mean, it's a matter of what you're going to say, take and touch or touch and take, but the combination has to be there. But it's not happening anymore. Like for instance, disbursement now in most of the cases, 100% disbursement, and rightly so, is to the bank channel. Meaning the money is now coming, not as a earlier 10 years back, what you used to see that they would come and pick up the money, the cash. It's all the case. Disbursement is most of the cases now electronic, and collection depending on entity to entity. In some cases, electronic fully. Again, I will not get the name. A few entities which are almost like 80, 90, 100% electronic. And in some cases, still there and all. So JLG model is not working, will not work for long uh, anymore because of those factors behind it.
Fair enough. I think you talked about the interest rate deregulation. I think that's a good point for us to delve a bit deeper into what happened in the past couple of years, the recent cycle which I've observed. That day, I read one of your columns where you called the day they deregulated it as a red letter day, and I thought that eventually became a reason to what happened over next couple of years. What we saw that earlier a lot of MFI problems were usually used to be because of external reasons like COVID, right, or a natural calamity. But I think last couple of years the reason we went through this the credit cycle was because of overlending, which was very fundamental to how the industry players were behaving. This is an observation I have made based on whatever little I've read. I'm sure you'd have much more to add. How do you see it? Was it again more internal or more external? And was that day the trigger this happened?
Yes, I did say it was a relative for the industry because Reserve Bank of India gave them freedom, which they are asking for. But I think even Reserve Bank of India regrets that because the freedom is, I'm sure industry will hate me for this, it's been misused. Okay, and from multiple platform, RBI Deputy Governor Mr. Swaminathan did flag up this issue that they're not judicious enough to enjoy this the way the freedom is being used. So what happened is this: their logic was 2001 and 2021, 22. They did bed loss because of the external circumstances. So aggressively, first they raise the loan rates. I think everybody raised the loan rates, and then it started over leveraging. I mean, there are three loans, four loans. I think I wrote in one of my pieces one borrower I came across having 14 exposure, 1 4. So all these RBI norms that 3 lakh household income, go by the board driven policy, see, etc., etc. Nothing happened. Of course, the two SROs, they got into the scene, and then, they put the guardrails that not more than 3 loans and not more than 2 lakh exposure, etc.
Was that a good job done, sir? The SRO guardrails?
Tried, I guess, but there is an inherent, again, it will not, people don't like to say that. Because how would the SROs work? I think the bulk of their revenue, in the sense they need to run, it was given by the entities, right? If my entire architecture is built on the subscription by these entities, so it actually, I don't think I can enjoy the 100% freedom to carve on these entities on whose money I work. Having said that, SROs were extremely careful. They have been doing their job. I think had there been no SROs, then things would have been far worse. But the fact is, as you rightly said, you said, and you want to hear me saying this. Yes, unlike in the past, where the politics played a role, where elections played a role, where aggressiveness, one entity played a role, natural calamities played a role. But this is actually made by probably the entire industry, barring exceptions, few exceptions. I'll just give you some number again. In FY 17, financial 17, the exposure was 1.07 trillion in the micro loan segment I'm talking about. By FY 24, it went up to 4.34 trillion. And you remember, 21, 22, it did not happen anything, it actually came down. So this 23, 24, it just zoomed. And then, since then, I'm just seeing is this microfinance entity, 23, 24, 25 portfolio stood at 4.26. By December 2025, this came down to 3.21. Okay, I am quoting one of those credit bureau data and all, and I understand this. Subsequently, I think that as we speak, the last in February, microfinance industry to total book size is 3.28, 3,28,756 crore, with witnessing 2.448% growth from the previous month. So in February, you was talking about till December, it was in a concentration mode. Now going down and down and down. Right now, as we speak, the worst is behind. Things are, and all these reflections also in terms of the credit quality. And if you go, I don't want to get into the technical aspects of 30 days, 60 day, 90-day, etc. But things are getting better. And you see this number of period, as I said, that financial year 2025 portfolio 4.26, 4,26,619 crore. December came down to 3,21,570 crore. And then subsequently, I said in February, it has gone up a little more. But during this period, the active loan accounts dropped 31%. So the volume of loan dropped 25%, and the loan number of loan accounts dropped 31% from 156 million to 107.4 million. That's the thing. And the number of borrowers, these are I'm talking about loan accounts, and I'm talking about the number of borrowers, including the defaulters, fell from 87 million to 69 million. So massive erosion in the overall loan volume, the number of accounts, and number of borrowers. That's the price the industry paid. And as a result of that, you are not asking me, but I am giving you, if it had not been on your question, is this the main source of money, the banking sector, that they have closed the gap. So there is no more bank money for them. For most of them, I'm talking about the not the big few entities. You leave that out, but otherwise, for most of them, the bank money is no more there. And well, I see that at the smaller level, and there are quite a few which have not been able to continue with their operations.
So, sir, help me understand the number going so high, like almost 4x between 2020 to 23, 24, and then also falling. All of this, I guess, was a function of supply elasticity, right? Because I'm assuming the demand for such loans was always there. If not for the formal channels, money lenders से पैसा चले आता था. I'm assuming during that period, maybe lenders became too liberal, and now when they realized that they were messing up, they became too strict. That's what happened, right?
You look at their balance sheets, you'll find that. I'm not getting into good, bad, ugly kind of stuff. I'm just saying the plain facts across scale, big, medium, and small. You look at them, how their balance sheet has shrunk. Because this is basically, if you are not able to continue the cycle of giving loans, then your balance sheet will shrink. And how do you do that? If they're the loan tap, the banks have closed, and most banks have closed their tap.
So the number you mentioned about how the number of active accounts has gone down 31%, right? What does this mean? Does this mean that now those people are no more borrowing? Do they mean that now they've shifted to informal channels? Are they starving for money? What happened to those set of people?
Depends on you were talking about the underwriting. And now underwriting is very different from unsecured loan, because the unsecured loan is a cash flow based lending. Cash flow based lending, unless it's not a balance sheet based lending and all. Now their cash flow has been impacted. Their cash flow, all those borrowers and all, their cash flow has been impacted. So when your cash flow is impacted, so essentially, if those are in the smaller businesses and they are closing down their business, they have not been able to do anything, and multiple things are happening. Yes, money lenders are also stepping in, and the loan apps, etc., happening and all. And most importantly, you see it was over leveraging, so people are taking more money than probably they require also, because as you said, it was a supply side problem, it was not a demand side problem.
Fair enough. Sir, one last question that I have for you before I let you go is I, as an investor, tried to play the microfinance credit cycle over the past couple of years and also got the opportunity to learn the cycle. What I wanted to ask you is ki, let's not take any company names. Let's say it's any lending entity, be it a small finance bank, an MFI entity, or even a bank lending money to a microfinance segment. What do I look at to understand, is the bank doing, or is the lending entity doing good at lending those money to the right set of people? I know for a fact NPS is something to look at, but by that time it's too late. Those loans have already been dispersed, they've already turned bad. I ideally want to stay away from those lending entities, or at least make sure that I hedge my bets as an investor. So if I'm an investor, understanding the business, what should I look for to avoid such things, or it's unavoidable?
You yourself said is underwriting. What's the underwriting capability? Now, if you look back to the banking industry on a larger scale, when Raghuram Rajan took over, he found that the banks were, they were hiding a lot of things. They are hiding a lot of things. They are not in the best of health. Their NPS was increasing and all, and there were multiple ways of camouflaging things and all. And Raghuram Rajan also find that in the basic economics says that whenever people do business, there is one part is debt and one part is equity. You bring your equity on the table, then you look for the debt, and then debt equity has a ratio depending on the particular business. But he found that there are entities and all, both the debt and the equity they are sourcing from banking system, right? So then he did what AQR, asset quality review, and which essentially said that, look, we don't trust your auditors. My auditors will go and get into your kitchen and your drawing room and bedroom and find out that. And what I said, with of course lightly and all. So bankers were doing actually belly dancing or something like that, and Raghuram Rajan forced them to do strip cheese. So essentially, they were stark naked. So, and then they found that at least two banks, one in private sector and one in public sector, found that 33%, 30% plus NPA. And then the recovery path came, and as we speak, banking system, you see the health less than 1% net NPA, and everybody is bullish on banks and all, because they change their underwriting. They are now more focused on their risk management, and underwriting is now far, far better than what it was till say 2017. And this is across all banks. Earlier, there was hard mentality. A large bank is giving money, so small banks are also queuing up and giving the same money, even though their risk-taking ability is very different. So what has now changed between then and now? Their risk management and underwriting. So the same thing when it comes to unsecured loan. Its difference is this: it's not balance sheet based; it's a cash based thing. So you need to understand the risk management. You need to do risk management well and underwriting well. That's the thing. And of course, more importantly, you need to see that they are not over leveraged. So the problem happened is not historically. In the recent past, you would find the same guys are getting many loans, even though they were need, it was their forced down their throat by the other side. It's a completely supply side problem. It was sort of harakiri or whatever you call it, suicidal, because they thought that good time will last, and that's how it happened. So from the investor's point of view, you need to see even in the banks there are, I'm again not name, they are into, some of the banks are into unsecured loan, but their NPAs are pretty low, not much there, because the advantage of unsecured loan is this: your NIM is very high, your spread is very high. There's a cost to it, credit cost to it. You can give some cost. I don't want to take some number and all. It cannot be less than 1%. Probably it will be a little more, definitely. But as long as your NIM and your spread justifies that, you can make more money over. And the other way is doing there's no stay away, and you keep your spread down and keep your credit score close to zero. So, but in the unsecured space, you earn more, definitely. But uh, to manage it, you need to understand the risk management and underwriting, and you need to say no to over leveraging. And I repeat, this is a completely supply side problem. You can't blame the borrowers. You give the borrowers more money, push down their throat, which they are not able to pay back. You did not think that it would come, but that's what it happened. And you regret this. Now you are, because your balance sheet is shrinking, you are not getting money from the banks.
Uh, Tamal sir, that's all the questions I had. If there's anything you think I missed talking about the industry, the floor is yours. If not, maybe we can just wrap this up.
Maybe we can talk about what's the new model they look for. Uh, I I think this model, apart from underwriting, and it's a part of the same thing. Better underwriting, better risk management, and not over leveraging all. But need to see that how to avoid that. One of the things I understand that many of the MFI NBFCs are doing is this: they're turning into BC, that is banking correspondence, meaning the books are. It's not they're not running their own books on behalf of banks because they have access to borrowers. They're giving them money. They have their collection efficiency if if the right persons are being given loan, and they can enjoy the commission. My understanding is this: a few I'm not going to name, but a few smaller MFIs are closing shops. They cannot survive. Many of the smaller, medium-sized FIs are turning into BCs, business correspondents. Larger FIs, yes, they can manage it now. But it's a high time, I think. They need to relook at their business model. They need to reinvent themselves. It can't go on.
I think I couldn't have asked for a better session on MFI from none other than you yourself, who's observed the markets for past couple of decades, much longer than I was, much before I was born. So thank you so much, Tamal sir, for your time. You were very generous with your time and very patient with my questions. Thank you so much.